the Checks and Balances podcast. We cover personal financial planning, business tips, and insights on investing markets. I'm your host, Tyler Curley, a financial advisor with Lincoln Investment and also an accredited investment fiduciary. I have 15 years of industry experience and have helped thousands of people and dozens of businesses with their retirement goals. Today's topic is inflation and the impact it has on you. Thank you for joining me. For those of you that would like to give a shout out, please email me at tcurley@lincolninvestment.com. That is TCURLEE at lincolninvestment.com. Or give us a call at 252-215-2241. So guys, I have seen article after article and countless sound bites recently about inflation. What exactly is inflation? The Google definition is an increase in prices and a fall in the purchasing power of money. Well, no surprise there. How many times have you heard someone say, I remember when gas only cost $1? Or when I was growing up, I could get a candy bar and a drink for 50 cents. In the last year, lumber, corn, and soybeans are up close to 100%. So why is this happening? Will it sustain long term, and how does it affect your money? There is not one reason inflation is occurring, but it's just a combination of events. The pandemic created pent-up demand among consumers that have been at home for the last 14 months. Essentially, we've been all sitting at home thinking about what we're going to do when we no longer have to sit at home. This is some of the issue, but maybe more so is a disruption in the supply chain. You cannot close down the largest economy in the world and not expect goods to become backlogged. So overall supply in really every sector is down. The government stepped in with stimulus and the Paycheck Protection Program to keep most businesses and individuals afloat. The government has almost $6 trillion in stimulus and is now discussing more with an infrastructure package. The cascading effect of more money in the system has to cause prices to increase. Supply and demand. Supply of money goes up, so does prices. Oh, by the way, we are still at extremely low interest rates, if not considered non-existent. Will this inflation sustain long term? If you listen to the experts, they are calling it transitory, and mostly in the consumer goods space. Transitory, by the way, is just really a fancy word for temporary. Cars, lumber, corn. Okay, I could probably get on board with that concept. But you guys need to remember this means that prices may not continue to go up, but it does not mean they will come down. Basically stating they're going to level off and then stay stagnant for a period of time. So I would not bank on prices coming down dramatically. I think they'll come down some, but dramatically I think we're in for a new normal when it comes to some of these prices. So they have changed their methodology when it comes to looking at inflation over the last, let's call it 25 years. Estimates are that if you use the same methodology as we did back in 1980, inflation would be double digits right now, which actually makes sense considering all the commodities I listed earlier being so inflated. I was talking with someone the other day and they felt like lumber in particular may take a year to stabilize. So with that being said, all of us thinking inflation is happening and could continue for some time, this is how it affects your money. The value of your dollars are going down. That means money in the bank, a CD, a money market, a checking or savings account will go down in real value. That has typically been the case. It's always been the case, at least for the last 25 years. But it will really exacerbate with an inflation spike. You should consider looking at different options for your bank assets. So you please need to give us a call and we can help you discuss it. We have many options ranging in risk levels. So we're going to switch gears a little bit and talk about the Federal Reserve. So the Federal Reserve's job is to set certain rates and control the money supply of dollars in our system. So this can get kind of complicated. So let's try to keep it pretty simple. The Federal Reserve is known as the Fed, and it will likely have to raise interest rates to combat the inflation issue. The Fed has danced around this topic a lot this year with cryptic innuendos that they might change policy. When anyone associated with the Fed mentions changing policy, which is code for raising rates, you get a sell-off in the stock market. Ultimately, no one from the Fed has come out and straight up said we are going to raise rates quicker than we expected. So why does this actually matter? The Fed controls the prime rate, and everything with lending revolves around the prime rate. So your commercial loans, your personal loans, credit cards, the only exception might be mortgage. Your mortgage is going to be more controlled by the mortgage bond market than say the Fed raises rates, it's not going to control the mortgage rate as much. Those are going to be more supply and demand oriented. It'll take some time. I'm not saying that if mortgage rates are going to not go up if interest rates go up from the Fed. They will. It just takes more time to actually show it. But let's stick with talking about prime. So the prime rate is the interest rate that commercial banks charge their most credit-worthy corporate customers. So you got a company like Apple. They are probably going to be paying the prime rate. And so that prime rate right now is 3.25%. So a lot of personal and business loans are going to be prime plus 1, 2, or 3% based on your credit score and credit rating. And if the Fed raises the prime rate, it is going to have a negative impact on businesses and the interest rates that they pay. So from a personal financial planning standpoint, if you have a line of credit or credit card with a balance that is connected to prime, you need to work to pay that off sooner rather than later. The other way that it potentially works towards your money when we're talking about rising rates, tech stocks always seem to sell off when you have the potential for rising rates. And if you watch the 10-year Treasury note, it will give you a good sentiment of where the market thinks rates will go. So typically, the 10-year Treasury note is representative of inflation movements. And so right now, while we're actually recording this podcast, the 10-year Treasury note is 1.64%. Okay? So that means you're basically loaning money to the government, and they're going to pay you back at 1.64% annually. So that's how much you get from a government rate at 10 years. How does that actually affect your investment portfolio? Most technology stocks don't make any money, and the value of their company is based on future cash flow projections. And those cash flows become less valuable if you have high inflation. So if you consider Tesla, Uber, or Snapchat, they are all going to go down in value when you have a rising interest rate environment. So again, while we're doing this podcast, tech stocks are up and treasuries are down. That is right now the sentiment of what's going on. It may not always be that way, but it's certainly that way right now. So if you're highly allocated to the growth sector of the market, you're going to experience more volatility, especially recently. So we're going to take a few minutes to summarize what we've talked about. Inflation is up, and it is costing us all more money to live. The action items for investors are to evaluate their portfolios and assets alike to make sure that they are where you need them to be. Our office can help by using financial planning software, and we can stress test your portfolio for inflation and how your debt plays into your overall financial situations. So please give us a call, 252-215-2241, or email me at tcurley@lincolninvestment.com. Thank you for taking your time to give us a listen.
Advisory services offered through Capital Analysts or Lincoln Investment, registered investment advisors. Security offered through Lincoln Investment, broker-dealer, member FINRA-SIPC. www.lincolninvestment.com. Robinson & Associate and the above firm are independent and non-affiliated. The views and opinions expressed herein are those of the authors noted and may or may not represent the views of Capital Analysts or Lincoln Investment. The materials presented is provided for informational purposes only. Nothing contained herein should be construed as a recommendation to buy or sell any securities. As with all investments, Past performance is no guarantee of future results. No person or system can predict the market. All investments are subject to risk, including the risk of principal loss.